The 10 most volatile forex pairs to trade, Pete. I crunched the numbers on every dollar-based forex pair that is
all
provided.
82 of them.
Well, the dollar-based ones, I think there's like 20 to 25. Looked at the realized volatility in all of those dollar pairs. We could break this out to all 82 as well. Obviously, with the different crosses, a lot of it ends up being a wash. So today, looking at the dollar ones, and a reason for this is we've seen a good amount of volatility recently. And before we get into the numbers, maybe you can speak a little bit to just what volatility is in forex trading, because from a definition standpoint, it's the measure in the variance of prices for any given time frame. Higher volatility correlating to a wider variance in prices, lower volatility, as you can see the example here in dollar CAD going back to last summer. Really, we're in a range of remember that we were in a range of 136 to 138 for months and months and months. Recently, obviously, getting up to the low 140s and then going all the way up to 148, backing off to 142. That's what volatility looks like from a technical standpoint, from a definition standpoint. From your view, though, in actual forex trading, what is volatility?
I think it is it's just it gives us a representation of the market's elasticity. What can I expect? What is the market? Again, if you're looking at that low volatility, and we knew that it was into 26 pips or something really tight.
The daily move,
Yeah. Well, I'm looking for a 100 pip move on something. It's not the right market for that. It's not the right situation for that. What that helps you do is set realistic expectations around entry and exit points. One of the hardest things for us to do is, and we didn't do this kind of math 30 years ago in the pit, is when volatility would change and we had our, I want to fade a 30-point up move or down move or whatever, and your scalping ranges wouldn't adjust to what the market was going on. And it was a difficult couple of days until you started realizing, I've got to adjust the ranges I'm trading. We now have so many tools that help us determine what that is on a very dynamic basis that lets us think about, okay, what's realistic to look for in a trade right now. It also lets us talk to scaling. How, if a market's moving 100 points a day, I'm going to either lower my unit size a little bit and determine where I'm going to manage my entry and exit points, or I'm going to accept that I want a wider range of prices before I participate.
Sure.
From a trader standpoint, incredibly powerful tool in helping us determine how we adjust the dynamic. It's not always, well, I don't want to risk more than 30 points a trade. That's a tough animal to skin. If you've got to be realistic around what the market is willing to give you and how you adapt your trading style to it.
Well, it's at the end of the day really synonymous with opportunity, or what is the measure, what's the potential for profit and loss per the trade size. And I love your point of, if the volatility is higher and the potential for profit and loss is larger, then I can drop down my size and spread my size out, as opposed to in low volatility times, if that smaller moves, smaller potential for profit and loss per one lot, maybe you reduce that range that you're expecting and maybe go back to your normal size in an environment like that. But I do want to point out something that it tends to be interesting. Okay, well, how do I know if there's volatility or not? Well, one, you tend to, even implied volatility in options, and I would contend that standard deviations and expected moves and these expectations,
derivatives of that
came from options becoming popular for trading in the 80s and 90s, and all the math that was done around it, and probably those options traders informing currency traders and different people of, hey, this is what the volatility looks like, so you shouldn't be expecting that 50 pip range. Actually, right now it'd be more like a 30 pip range. But even implied volatility from options tends to be backward looking. And so you are usually kind of behind the eight ball a little bit in when volatility starts, but it does tend to cluster, like we saw here. The dollar CAD market, it rips up to 142, 144, and then it hangs in there for a couple of weeks, and then you see the big move up to 148. But then we've seen since then weeks of big moves in that dollar CAD market, it also can be correlated to price extremes. It's no coincidence that the dollar CAD market is at its highest prices since 2003, and it's been particularly volatile in the most recent trading. And a little bit of this has to do with the uncertainty around these price extremes, and liquidity tends to dry up a little bit. Not in the case of like, oh, the spread in this market is usually 1 pip and now it's 5 pips always, but liquidity around price extremes can get, like I say, a little dried up because of that uncertainty.
Absolutely, and there's more participants. I mean, if you think about it, the world of FX, $6 trillion a day exchanged in the interbank market. It's not just guys all with an opinion wanting to be long or short. Within that are a huge component of end users, businesses,
big
manufacturers
institutions,
who have currency exposure in their global economy. Now, when a currency isn't moving, they tend not to hedge. Hedging's a cost. It's something you bear. When currencies start to move and there's a material impact on what your revenue is going to be given the movement of the currency, you see more hedging take place. That's more volume coming in, consuming more liquidity, and fueling more volatility. So it's oftentimes you see, like what we saw in Canada, these runs to new highs are like, wow, it keeps going. Well, the more it moves, the more these institutions have to hedge, the more core participants have to. So you get more elasticity, more volatility, more participants.
Yeah. So yeah, that's even around these unknowns, maybe less liquidity per pip, because that a lot of the market makers, different people have widened out. But to your point, maybe even more volume and more participants in the market, which can actually end up being a plus.
And as long as you, again, implied volatility by its nature is implied at the moment, looking backwards.
Yeah,
it's still a useful tool. There is no indicator that, well, in 10 days, vol's going to be here, so I'm going to trade accordingly.
It's an impossible. It's a game that people have been trying to play forever.
Right.
Buying different versions of the VIX, waiting for it to pop. It's very hard. But here we have the hard numbers on historical volatility, and we've got the top 10 most volatile FX pairs of the most recent trading sessions, the last several weeks and months here. And Pete, are you surprised at this list? I'll run down it as you digest it for yourself. Dollar peso, the South African rand, the SEC market, which I don't think I've even ever traded it. But that is part of the main dollar basket,
That's
right?
Why.
The Dixie. So we can talk a little bit about that. Dollar CAD, one of your first majors in there. And so no real surprise to me. I am surprised that dollar yen market is still so volatile for being, I mean, that's historically a top 3 major market, and it's in the top 5 of most volatile. Usually you tend to see, similar with stocks or whatever, larger market cap, whatever, less volatile.
Absolutely.
Not seeing it there. And then, of course, what you would expect, that Kiwi and that Australian dollar, both decently volatile for relatively, small notional sized markets, but a mid-tier major U.S. dollar pair. And then bringing up the rear there, number 9 and 10 is your pound and euro. But decently volatile. I mean, pound at 7%, that's some nice movement.
And you're absolutely right, because traditionally, in terms of volatility, it's Aussie and Canada, euro, yen, and the least volatile long-term was always cable. So this is a little bit, and again, that's looking back over a longer period of time. This is really a recentering of the table a little bit. So it's non-traditional to see sterling volatility above euro vol.
And that yen
or to see yen vol above Aussie vol.
Crazy. So, but yeah, that dollar CAD, probably not usually the most volatile of the commodity currencies, let alone top 4.
Right. We look at 20-plus year extremes, that kind of lends itself to
exactly right. And I just want to go out with this. For those of you that do like to use those expected moves, we'll be crunching those numbers even more and more often, and probably going out with them on email and everywhere else. But yeah, if you're looking at the expected move, for example, that dollar CAD, looking at 80 pips right now, which is pretty big movement, obviously, with the movement that we've been seeing.
That is a big move, considering we were at 26 pips 6 months ago.
Well, we've just seen such, I mean, we've seen 100, 200, 300 pip days in that market recently.
So as a trader, that doesn't mean, well, that's scarier or anything. All that does is you can widen out where you want to participate. You can use your same, your management structure doesn't change, which is great. When you come up with one that works for you, you get to customize the dollar exposure by your size, but now you have a guidepost of within an 80 pip range. Is it likely you can harvest a third of that or half of that if you're scalping? Yeah, when you get down to 26 pips,
it can be
picking
tough.
the right level to get half of 13 is tough to do. So that is empowering to a trader. It doesn't, well, these are too volatile now for me.
Yeah.
Again, how do you tame volatility? Mechanics and size.
Sure. It's just, it is what the market is.
Yeah.
A good,
which is great.
Most traders will trade high and low volatility.
Fantastic walkthrough because it sets up, it sets up realistic expectations. When you look at Euro, well, we had 100-point rips around tariff talks. I don't want to sell it or buy it unless we get a 100-point up or down day. Nothing wrong with that. The chances of you getting that right now are going to be a little bit.
A 2 standard deviation move. So
that's going to be tough.
Less than 5% of the time.
Right. So you're not to say you're going to be disappointed, but you should set your expectations. If that's your goal, you're less likely to be engaged with that market. That's fine.
Absolutely.